What is happening with inflation and the CPI? What is happening with stocks earnings? How do we ride this kangaroo jumpy market? Hang on.
This is not financial nor professional advice. This video is for entertainment only.
Hey everyone. The year started out with the market being in a very sour mood, but then making up for all the down days on the first Friday to close the first week of trading, of stock trading for the new year. So I believe this came about as a misinterpretation of the data coming out on the economic calendar. I think they were overly optimistic about the jobs report, and I think they were seeing signs in the PMI services number that really weren't that much to celebrate. They were happy that the hourly wages were expected to increase by 5% year on year, but they only increased 4.6%. And they made a big deal about that. Month on month, wages still increased, but they were just happy that the wage increases weren't accelerating. And that's to celebrate that very minor victory was not paying attention to the number of jobs increased by 223,000 when only 202,000 were expected. It was 21,000 more jobs than they expected, okay, which indicates that employment's increasing. And indeed, it did increase. The unemployment rate was expected to come in at 3.7%, and it came in at 3.5%. You know, this is one of the lowest employment rates ever. So how they're seeing that this isn't inflationary just really puzzles me. It was a much bigger deal that the ISM Services Index, the services PMI in December, came in at 49.6. Anything below 50 is a contraction. And there had been no contraction in the services PMI for the previous 30 months. So it was the first sign of contraction, which is what the Fed wants, which is a much bigger deal. And also this 49.6 was 6.9 points lower than November's reading of 56.5. So it was the fact that it contracted, and then also the massive 6.5 points of droppage from November that signals that services are contracting, which is what the Fed wants, and might influence their decision about how much they're going to raise interest rates on February 1st. There were other factors that led to that big rally the first Friday of 2023. One was that the dollar was weakening somewhat. When the dollar goes down now, that leads to stocks increasing. It also leads to metals increasing. And there's an interest in gold that I'm going to be explaining. And also the 10-year bond, the interest rate was falling to around 3.5%, and it had been higher than that before. So that was also a thing that helped propel the rally. But the rally really didn't last. The following Monday, it started out strong. You know, the NASDAQ was up a couple hundred points, okay, and it ended like up maybe 80 points if no, it ended up 0.63% on Monday, and it was like up 2.5% early in the day. So basically, it was trying to follow through with the rally, and then it fizzled. Most of the afternoon was spent just watching the Nasdaq go down, and the best way I found to trade this market, because it is so jumpy and it is so choppy, is to day trade it. And I day trade it with my old friend SQQQ because I know how it moves. And I don't hold overnight. I don't trust this market to hold it overnight. The best way I found to trade SQQQ for me, and this will not fit everyone else's style. It might be idiosyncratic to me, but what I do is I wait for SQQQ to go down a lot, and that means the market is rallying strongly. And what I found out is that all rallies fail. After watching 4 of them go down the tubes, I'm having a very difficult time believing in these rallies. So when it rallies strong, I just watch it go up and go up and go up. And when it starts to reverse, and then starts to reverse convincingly, then I jump in on SQQQ. And that's been a very profitable trade, and one which I will continue to do. I should explain that SQQQ is a triple leverage. It's a triple leverage inverse fund on the 100 largest companies on the NASDAQ. So you're basically shorting the 100 largest companies on the NASDAQ, which includes all the FANGs, the Apple, Amazon, Alphabet, Netflix, Facebook, Meta, plus Microsoft, plus Tesla, all your big mega cap stocks. So you're shorting the QQQ, which is the 100 largest companies on the NASDAQ, and the S stands, of course, for shorting the QQQ. And for every $1 that the QQQ goes down, you make $3 because it's triple leveraged. Recently, gold, which is called the old man of the metals, is starting to take off. And I've heard people say, yes, it's good. Metals generally will take off when the dollar drops. But gold seems to have an extra oomph to it. And it seems to be coming alive, and it might be something I'm going to trade. I have to see how it pans out. Of course, if the market crashes, like Mike Wilson of Morgan Stanley says, it will drag everything down, and I'll resist in that case. But I might short-term trade it, and maybe more than that if things work out with it. I'm going to see how it develops, and I might be talked into it. And I'm going to give you a long-winded discussion of this because it is very complicated, because it involves gold, oil, China, Russia, Ukraine, and possibly Taiwan. The way it involves oil is... And it involves the United States reserve being the reserve currency that oil is traded in. Other nations, they call it the petrodollar, and it's traded in the United States currency, the dollar. And that's very good for the United States, but it's not good for other countries because our currency is much stronger, and they lose money on the exchange rate. Because the United States is the reserve currency, we can cut different countries out of the economic system if we think they have violated the international rules too much, which is what we did to Russia after they invaded Ukraine. And China has never ruled out the use of military force with Taiwan, and it's conceivable that they could attack Taiwan and that the United States would give them sanctions and more or less cut them out of the economic system. And so you have the East China and Russia sort of banding together against the West, Europe and the United States and some other countries. And you have this tension, and they have moved to try to to back their currencies up with gold, because they don't feel that they can rely on the United States. They don't want it that the United States can cut them out. And what's happened is the Chinese are in the process of setting up an exchange where you can exchange the yuan for gold. So that would be an advantage to some countries. They want to be able to involve Saudi Arabia in this, so that people can trade oil in the yuan, which is a much weaker currency, so that they get a better exchange rate, so that they get oil at a cheaper price. So the bottom line to all this is that for various reasons, which include political and economic reasons, China and Russia are buying all kinds of gold. Incidentally, I hear that India is also buying all kinds of silver, and the price of silver tends to move in sympathy with gold somewhat. So silver might be an investment too. But I favor the old man, as they say. It is the standard. It is sort of eternal. There are two ways I'm thinking of trading gold. One is to use a commodity ETF like GLD, whose shares reflects the performance of the price of gold bullion. It's a spider. It's part of the S&P 500, and it reflects the actual price of the bullion, of the gold bullion. The other way is to use a leveraged fund, and I would leverage the gold miners. And these are it's an ETF composed of individual stocks, which reflect companies and stocks that mine gold. And it's double leveraged. For every dollar that the gold miners index goes up, you make $2. So I think these are both good ways to do this. Looking at the 6-month chart, comparing the performance of the two, you can see that in the 6 months, in green is GLD, and that has gone up 7%. That's based on the price of gold bullion. And the NUGT, which is the gold miners ETF, which is double leveraged, that's gone up 21%. So I think I'm probably going to favor the NUGT because it gets you there a little bit faster. And I don't know how long term of a trade this is going to be. It depends a lot on the political factors and just how a lot of things pan out, how the war in Ukraine pans out, how the petrodollar works out, whether this plan to back up their currencies with gold actually works, whether they continue to pursue that or they give it up at some point. These all play into it. So on Thursday, January 12th, we have the big event, the Consumer Price Index, the CPI, which indicates how inflation is doing. It's expected to come in at 6.5, which I think is really a Goldilocks prediction. We don't want it to come down too much, because that'll indicate a recession is coming on. But if it comes down just the right amount, and 6.5 would be about the right amount. Previously it was 7.1, so that would be 0.6 of a point reduction in inflation, which would be very good. And then on January 27th, we have the PCE comes out. That's the personal consumption expenditures. And the Fed looks at that a lot to get a gauge of inflation. But the big event is February 1st. And that's when the Fed will actually raise the rates. And they say there's an 80% chance that they will raise it 1/4 of a point. There's about a 20% chance that they won't raise it at all, which I think is fantasy. They're going to raise it 1/4 of a point, I think, in my mind, for sure. And if the numbers are bad on the PCE and the CPI, they'll raise it 1/2 a point. The next CPI for the next month is on, I think that's Valentine's Day, February 14th. So we hope it's a happy Valentine's Day. Friday the 13th, we have a lot of banks reporting earnings, and Citigroup, Bank of America, Wells Fargo, JP Morgan, and BlackRock all report earnings. And we have one major airline, Delta, reports, and also healthcare. We have United Healthcare Insurance reports earnings. So we should get a good preview of how earnings are going to go. This is the banks indicate a lot how the economy is doing. Plus we have a major airline and a major healthcare insurance provider. So we should get some idea how things are going to go from this Friday. Thanks for listening and watching. Be sure to smash that like button. Be sure to subscribe if you haven't already done so. Hit the notification bell if you want to be notified of future videos. And thank you very much.